should I cash in my UK pension abroad? If you are living overseas and have a UK pension, you're wondering, should I cash it in? What I'm going to do in this video is break down the taxation as a non-UK resident. I'm going to break down the reasons why people look at cashing in the UK pension and the pros and cons for them, and also most importantly, key considerations to consider before actually making that decision. So first of all, from a taxation point of view, if you are a non-UK resident and you've never taken money from the pension pot before, your pension would be what they call uncrystallised. So 25% would be paid gross of tax and 75% would be tax at source in the UK. So the 25%, that is what's called the pension commencement lump sum, or also could be referred to as the tax-free lump sum. And this is tax-free in the UK, but once you leave the UK, it depends on what the treaty says between the country of where you're living and the UK. Sometimes they tax it in the UK, which means it would be tax-free. Other times it's taxed as income tax, and sometimes there could be exemptions depending on where you're living. We have the full DTA list, so the double taxation agreement list, and we can break down exactly how it would be taxed in the country of where you are planning to take the money out. So that's the PCLS, the pension commencement lump sum. The other 75% would be taxed at source in the UK, which means you have to claim that money back. And claiming the money back, it isn't an instant thing. It can take quite a few months. So if your plan was to cash this pension pot in and you thought you were going to get paid the gross amount, that's highly unlikely unless the pension pot's really, really small. And you may end up having to wait until you've claimed that money back, which could be months in advance. And there is one way around this if you had the NT tax code, but if you are withdrawing a pension of more than £100,000, instead what you'd have to do is file a self-assessment form. So the actual options really depend on the size of the pension and where you plan to withdraw this money from. So that's the taxation side of it. So let's just say, for example, you've got £1 million in your pension pot and you are taxed 45%. That £1 million is now worth 550,000. So you've lost 45% on day one, which means you need to make not 45% to get back to $1 million, but 82. So 82% just to get back to square one. So if the reason for cashing your pension is to make a different investment, you would need to make 82% just to break even. If you plan to just make a normal investment, also be aware that within the pension scheme, you may have the option of buying direct stocks, funds, ETFs. So it's about making sure that you can check if there is a like for like with the investment options that you plan to make outside of the pension if you cashed it in. And if you do have investment restrictions, then it's just a case of transferring that pension to a more flexible arrangement. And there are options that are available for non-UK residents where you can also buy, for example, different funds or ETFs in other currencies apart from GBP. The third one that's quite common is cashing in your pension pot to either pay off your mortgage or even just buy a residential property outright. And if the plan is to buy outright, this really depends on what other assets you have, because if it is detrimental to your retirement plans, then it's unlikely this is going to be the right decision. Because let's say, for example, you've cashed this pension pot in, you've now bought a property for £550,000, you've effectively lost £1 million in assets for retirement, because that £550,000 is now in your residential property, which provides you with absolutely zero income in retirement. The only way you'll make money from that is if you downsize in retirement, so you sell the property and buy something cheaper and then use the other funds to provide you with an income. Or I guess you could rent out rooms whilst you're living in the property, but it's unlikely if you've retired in the 70s and 80s that you want people living in the property with you. So if that is the reason, then it's unlikely that's going to be the best decision. What you could do is look at, for example, taking out a mortgage, because if you've put down, for example, just 100 grand from the 550 and you've taken a mortgage out of 450 grand, you could, for example, invest that 450 grand and pay off the mortgage from growth within the investment. Again, this depends on your attitude to risk, what your capacity for loss is, so it's not a case of, right, this is okay for everyone, because it's not. So it's reviewing your overall situation to work out which of these options is going to be the best. So there's a lot of cons there, of course, because generally speaking, it is best to leave it in the pension pot. There are certain scenarios where, for example, it may be in favour for doing so, such as if you're in ill health, and it's a case of, right, I'm just going to spend this money whilst I'm still alive. But things you need to consider is, first of all, can I take this money from somewhere else that's either more tax favourable or easier to access, and won't have a detrimental impact to my life. So, do you have other investments? Can you remortgage or refinance certain properties that you've got and release equity? There's loads of different scenarios that you could look at, as opposed to just cashing in your pension pot. So it's looking at all of these different options and assessing which one is going to be the best for you. And speaking to a financial advisor is probably the best with this, because they will understand each different product, the different tax rates, and which one will end up being net better off. The second thing is just to consider whether or not any of these options are even worth looking into, because the pension pot is supposed to be used for retirement, so cashing it in is often not what they're used for. If you are looking to use capital for something else, it could mean that maybe that's just not the best option to look at. What completely changes this whole thing is if you're moving to a country where there's no income tax at all. And just because there's no income tax doesn't necessarily mean that you can cash the pension in tax-free, because it does depend on the tax treaty. But if the treaty does mean that you can take the pension pot out with 0% tax, then this could be a favourable option, because UK pensions, as of the budget, autumn budget 2024, now do fall under estate for inheritance tax. So you could, for example, cash the pension pot in a tax-free environment. You could invest that offshore, and if you're outside of the UK for 10 consecutive tax years, then, and your money's outside of the UK, you've just avoided a 40% tax bill on those funds. Of course, this does depend on whether or not you had an inheritance tax liability anyway, which is based on the nil rate bands. So the different brackets depend on where you're living. So in the UK, for example, you've got £325,000 as a nil rate band, plus you've got £175,000 as a residential nil rate band. If you're overseas, it's just 325, and as a married couple, there's 650. So if it was a case of doing this for inheritance tax planning, then you'd need to have assets of above £650,000. So yeah, there's many things to consider. It really isn't straightforward. If you do need advice on whether or not this is the best option for you, then please speak to us. We can give a breakdown on the country where you're living, of whether or not it makes sense, and take it from there.